Thank you for purchasing this video learning tool from TradeWinds Publishing. TradeWinds is one of the nation's leading providers of learning tools for investors. All TradeWinds learning tools are designed for one purpose only, to help you improve your investment results. We're certain this tool will help you accomplish that purpose. In fact, we guarantee it. For more information on this TradeWinds presentation, or to learn about other TradeWinds learning tools, call the toll-free number on your screen. Again, thanks for your purchase. Now, on with the show.
Good morning. I'm Chuck Hughes. Welcome to the Guaranteed Real Income Program Seminar. I want to thank you all for coming. Appreciate you coming out this morning on a Saturday morning. And we have a great program for you. You're going to learn a lot today. And let's get started. Let's talk about the objectives of the Guaranteed Real Income Program. Our first objective is to make profits during bull or bear markets. The last 5 years, it's been easy to make money in the financial markets because we've been in a long-term bull market. The last year or so, it's been a little more difficult. So we're going to teach you strategies today that will enable you to make money in bull or bear markets. We also want to achieve high returns with relatively low risk, and we'll show you some strategies that you can achieve that. And we want to build a diversified portfolio by investing in different asset classes that have a low correlation of returns. Some examples of that would be stocks, bonds, preferred stocks, puts, calls, preferred stocks, and zero coupon bonds. Those are asset classes that have a low correlation and can help smooth out your equity returns, especially during a bear market. And we also want to learn how to acquire assets at a discount to their actual worth. This will help reduce your risk and also increase your returns. And then we want to achieve specific investment goals such as retirement, saving for a second home, or your children's education. And we want to use strategies that have predictable returns to do that. And we're going to show you strategies that you'll be able to achieve that. And just to give you a little confidence in the program, I've included some of the actual returns that we've been achieving over the last couple of years. I have a advisory website, and over the past year, the trades that were recommended on the website produced $609,000 in actual profits. So I want you to have confidence in the strategies because they really work, and we have actual results to back up everything. And in the beginning of your manual there, I have the trades I took from 1997 through 1999. And that's in the introduction there. There's 2 pages there in the beginning. And those are all the actual trades from 1997 through 1999. And during that 3-year period, the trades were 93% profitable. And those are the results of all the trades, not just selected trades that we picked out during certain periods where it was doing well. So that's all the trades for a 3-year history. And then, of course, the website has the track record for the past year. And this track record has what we call a profit factor of 17 to 1. That means for every dollar of loss, there was $17 of profit. So that's a pretty comfortable way to trade. And most of the trades were taken in my IRA and Keogh accounts. So a lot of the strategies you can trade in your retirement accounts. And margin was not used except there was one strategy, the market neutral strategy, which we'll learn a little later. I did use margin on that. And a lot of the trades in this track record were covered call trades on blue chip stocks, and that's a conservative, low risk strategy, and that's also suitable for retirement accounts. We're going to go into detail on covered calls in Chapter 7, and they give you a possibility for real good returns with very low risk. And my Grip Advisory website over the last year, we had 84 recommendations for covered calls. 83 of those trades so far have been winners, and we've had one loss. And the total profits generated by the covered calls was $296,000. So that's a pretty good record considering the market conditions. And we're also going to talk about alternative investments to the stock market. That's very appropriate for the past 6 months when we've been in a bear market in both the NASDAQ and the S&P 500 index. And I'm going to show you a U.S. Treasury security that actually outperformed the S&P 500 index by more than a 6-to-1 margin from 1982 through year 2000. It's hard to believe because that was the greatest bull market in the history of stocks. But there's actually a U.S. Treasury security that's fully guaranteed by the U.S. government that actually outperformed the S&P by a wide margin. That's hard to believe, but it's true. And I'm also going to show you a mutual fund that invests in U.S. Treasury zero coupons that's actually outperformed the NASDAQ index over the past 6 months, the past 1 year, and the past 10 years. That's also hard to believe. Okay, and just a quick overview of what we're going to do. In part one, we're going to learn how to select a stock or an index using fundamental analysis, technical analysis, and seasonal analysis. And that's the first and most important step when you're implementing an option strategy is you want to do your analysis first to make sure you have a good candidate, whether it's a bullish or a bearish strategy. First thing we're going to talk about is fundamental analysis when we're trying to select a stock for a option strategy. And fundamental analysis is a discipline where you study the earnings, the dividends, the cash flow of a company, and that's normally that's the standard way of evaluating a stock would be to examine its earnings growth or maybe its return on equity. But I found that the earnings growth is not always reliable or very predictive of a stock's performance because the earnings is subject to interpretation by accountants, and there's a lot of pressure nowadays to, meet the earnings or beat the earnings, and it's not always a good indication of whether a company's really growing. Okay, so I came up with a better way to measure a company's growth. I call it the real growth indicator, and the real growth indicator, it measures the characteristics of a good business. Number one, companies with little or no long-term debt. Number two, companies with strong earnings and the ability to retain those earnings. And then the third would be companies that successfully reinvest their retained earnings. This pretty much follows the guidelines of Warren Buffett. He looks for companies that have these characteristics. And I worked in the airline industry for 20 years, and that's a good example of an industry that doesn't follow these guidelines because they very rarely retain their earnings because they always had heavy capital expenditures for purchasing airplanes, and they have a very high labor cost. So that would be an example of a company that doesn't retain their earnings and doesn't get a good investment on their retained earnings. Now, the way we measure the real growth indicator is we measure the book value growth. And the book value is calculated by subtracting the liabilities from the assets of a company. So if you can track the book value growth, then you're going to track all those favorable characteristics, and it also will track the unfavorable characteristics. If a company takes on a lot of debt, that will show up in their book value growth. That'll reduce their book value growth. So I found it's the best way to identify real growth companies. If they're growing their book value, then they're growing the net worth of the company, and that's a company that you want to study further. And what I did is I took a couple examples of companies that had a healthy book value growth 5 years ago in 1995. And then I traced their progress over the last 5 years just to see what their overall return was. This is a chart of Cisco Corporation, not the tech stock, but the food distributor. And in 1995, they had a real growth rate in their book value of 15%. And then their 5-year return was 361%. So that's an example of a company with good book value growth and a good return over the last 5 years. Here's another example. This is Sears Roebuck. And in 1995, their real growth indicator was a minus 8%. So they've had a negative growth in their equity. And then their return over the last 5 years has actually been negative, a negative 15% return. So there's an example of a company that they probably had some one-time write-offs that occurred that reduced their stockholders' equity or their book value, or they may have taken on debt. And in any case, they had a negative book value growth and actually a negative return over the last 5 years, and we've been in a tremendous bull market. So that's a good indication that if you had looked at the book value growth 5 years ago, you might have said, no, I don't think I'm going to invest in this company. The real growth indicator, that's one way we can tell if a company's healthy and it's really growing and if it's worthy of further study. And another indicator I've used over the years has been the Standard & Poor's ranking of a stock. They rank stocks for their 10 years consistency of earnings and dividend growth. And they rank over 10,000 stocks. Only 81 of these stocks have an A+ rating. So if you see a stock that's got an A+ rating by Standard & Poor's, that's another company that you want to take a look at. And what we're trying to do here is we're trying to find good companies so we can implement the covered call strategy or a put selling strategy on the company. And those are strategies that we'll learn as we get further along here. And I have a list of all the Standard & Poor's A+ rated stocks in the manual there. Here's an example of some of them: Abbott Laboratories, Aflac Insurance, Alberto Culver, American International Group, Automatic Data Processing. So these are all companies that have had very consistent earnings and dividend growth. So these companies are worth taking a look at. And then another screen I use to find good, healthy companies is Moody's list of dividend achievers. And the dividend is really a good indication of a company's health because they're not going to declare a dividend unless they have the money to pay it out. So if a company has a high dividend growth rate, you know that they're doing well. And this is a sample list of the dividend achievers. I have the full list in your manual. But in order to be a dividend achiever, the company has to raise its dividend for at least 10 years in a row, 10 consecutive years in a row. And you can see some of these companies, like Cisco Corp, the food distributor, they've increased their dividend 23 years in a row, and they have a 24% dividend growth rate. So that's an indication to me that that company's healthy, it's growing, they can afford to pay out dividends, and they're increasing their dividends on a regular basis. A good sign. Okay, so we covered fundamental analysis, and we want to look at the real growth of a company, whether they may be an A+ rated stock by Standard & Poor's, and if they have a good dividend growth rate. So those are three areas that I use to do fundamental analysis. Now, once we find a good candidate, then we want to do technical analysis on the stock. And technical analysis is a discipline where you study the price patterns. And you want to try to quantify whether a stock is in an uptrend or a downtrend before you would proceed with either a bullish or bearish strategy. And you've heard the expression before, the trend is your friend. You always want to trade with the trend. It's very critical to any successful option strategy or stock strategy. You don't want to try to pick tops or bottoms. That's a mistake that's made by beginners. It's very risky, and when you try to pick a top or a bottom, you're trying to guess, and that's just gambling. So we want to do technical analysis on any stock before we put on a bullish strategy. We want to make sure the stock is in an uptrend. And your trading will be much more successful if you initiate trades once a trend is already established. A good example of that would be, the NASDAQ over the last 6 months. People have been trying to pick bottoms on that all the way down. If you used technical analysis, you would have never bought the NASDAQ or most of the stocks in it because they've been in a downtrend. And the simplest way to identify whether a stock's in an uptrend or downtrend is to use a simple moving average. I just use a simple 50-day moving average. If the stock is trading above that average, it's in an uptrend. If it's trading below the 50-day moving average, it's in a downtrend. It sounds very simple, but that's a very critical part of any successful trading program. If the stock is below its 50-day moving average, you don't want to buy it. If the NASDAQ index is below its 50-day average, you don't want to buy it. It's a very simple concept, but very, very critical to implementing any successful trading strategy. I've got an example here. This is a chart of Philip Morris, and it's got its 50-day moving average, which is this line right here. I started buying Philip Morris at around $36 to $38 a share, right around this area here. I started buying it because it was above its 50-day moving average. It had a healthy book value growth, and it was rated A by Standard & Poor's. And I started buying it. It stayed above its 50-day moving average, and now it's trading up around 51.5. So there's an example, obviously, of a stock in an uptrend. And this is a chart of the NASDAQ. And this starts in September, and it comes up through March of 2001. And you can see it pretty much the whole period, it's been below its 50-day moving average. So that's a clear sign that you don't want to own that index. When it's below its 50-day moving average, it's very simple. you don't want to own it. Now, a lot of people kept saying, you know, it's oversold, buy, but as long as it stays below this 50-day moving average, you don't want to take a long position. And that it's simple, but that'll save you from a lot of trouble and a lot of losses. Okay, again, trading with the trend. If the trend is down, don't establish long positions. Whenever you take a long position, it's much less risk if you do it when the trend is up. And we want to do that for covered calls, bullish spreads, and put selling, which are all option strategies that we're going to learn. So we want to make sure that before we establish any of these trades, that the stock or the index is in an uptrend, as defined by its 50-day moving average. And here's a chart of Cisco Corp. And I started to buy the shares around $22 to $23, right in this area in October. Just as the techs were going down, these old economy stocks were starting to go up. So there's an example, again, of following the 50-day moving average. It's going to get you into the sectors and the stocks that are in an uptrend and get you out of the sectors or stocks that are in the downtrend. And there's a few more examples here of the old economy stocks that I started to buy around the same time frame. Here's United Health Group. Again, you can see August, September, October, it's in an uptrend. The techs are in a downtrend. So again, if you follow these 50-day moving average, you're going to gravitate towards the right stocks to own. So again, the stock market's it's in a constant sea of change. There's periods when the value stocks are in favor, then there's periods when the tech stocks are in favor, and vice versa. But technical analysis, can guide us towards the sectors that you want to own and get us out of the sectors that you want to sell. So trading with the trend is probably the most successful part of any trading program. And again, the tech stocks are currently in a bear market, but they'll eventually bottom out and they'll become revalued and become a buy again once they start moving above their 50-day moving average. And this is nothing new. This type of a sell-off in the techs has happened many times before in different sectors. Here's some examples of sectors that went through a big bull market only to crash and come down to more reasonable valuations. So this has happened many times before. This is nothing new. So we've talked about fundamental analysis, picking a stock that has a healthy growth rate, and we've covered technical analysis. We want to make sure the stock is in an uptrend. And now we're going to talk a little bit about seasonal analysis in stocks. And my partner Dwayne Davis is a computer whiz, and he's done a lot of work and research with seasonal analysis. What we did is we went back 50 years in the S&P 500 index, and we went back 30 years in the NASDAQ, and we had the daily price movement of those indexes. So we were able to pinpoint some really good seasonal tendencies in stocks that we can take advantage of. And we found that there's a bullish period in stocks from around November 1st through April 30th each year. And that 6-month period accounts for 98% of the compounded growth in the Dow average since 1950. So let's think about that. 6-month period accounts for 98% of the total return, compounded return in the Dow. So that's a pretty strong pattern. And the flip side of that is the period from May 1st through October 31st. And of course, that only accounted for 2% of the gain, compounded gain in the Dow. So you can see there's a clear period there where you want to be in stocks, long positions in stocks, and there's a period when you want to lighten up or be out of stocks. Now we're going to take a look at it. This is a 25-year chart of the Dow, 1950 to 1974, and you can see the bullish period again starts around October and ends around April or May. Very strong trend during this period over the 25-year period we're studying here. And here's another 25-year chart. This is from 1975 through 1999. And again, you can see at the end of October to the end of April accounted for almost all of the gain in the Dow for that 25-year period. It's a very strong pattern in the market. And you can see the other period, roughly from June through October, the index actually lost ground during that period. So this points out that strong trend from October through the end of April. And we'll show you how we can take advantage of that. If we want to take advantage of that trend, what we'd want to do, obviously, is buy a stock index at the end of October and hold it through the end of April. And we've done studies on just that. If you were to invest $10,000, let's say at the end of October, what would that have grown to by the end of April over this 50-year period? And assuming that you bought the Dow average in 1951, by October of 2000, that $10,000 would have grown to $380,000. Here's a chart of that equity graph. You can see from 1951 to 2000, $380,000 growth. That's compounded growth of $10,000 during that seasonal period. Now what we do is we, during the period from May through October, when we're not in the market, you would invest that money in T-bills and collect interest during the six-month period where it's not a bullish period. And this chart shows the growth of $10,000 by entering. We found out that if you enter the last 2 trading days in October and then get out the second trading day in May, that your growth of $10,000 will go to $1.7 million. And we have a year-by-year return in your manual of this strategy, of buying it second to last trading day in October and exiting the second day in May. And what we're trying to do there is we're trying to take advantage of that last 2 days of each month, and usually the first couple days of the new month, where there's a strong tendency for the market to go up. Now you can compare that $1.7 million to the other half of the year, where if you invest $10,000 on May 3rd and into the stock market and then exit on the second to last trading day in October, your $10,000 would have grown to $31,000 as opposed to $1.7 million. So you can see that that's a definite trend that you want to take advantage of. Here's the growth of $10,000 to $31,000 during the unfavorable seasonal period. And this $31,000 was due mostly to the interest that you collected on the T-bills for when you were not invested. And there's several securities that you can buy that will track these various indexes. There's the Dow Jones Industrial Average, the diamonds, symbol DIA. It trades like a stock, but you own shares in all 30 of the Dow stocks. It's a trust. So if you wanted to buy the Dow average, say on October 28th, you could buy shares in the diamonds, DIA. The S&P has the spiders, symbol SPY, and the NASDAQ 100 index has the QQQ, the queens. So that's how you would buy an index to take advantage of this strategy. And here's the growth of $10,000 in the S&P index over the same period, 1950 to year 2000, where we enter at the end of October and exit at the end of April. By using the timing model, you get about 3 times the profit than if you just bought the index and just held it for the whole period. 3 to 4 times the profit. So it's definitely worth it to time it during this seasonal period. Okay, and we'll just summarize quickly our timing model. It was profitable during the year 2000 bear market. In other words, when we got out on May 2nd, we had a profit for that year. It's simple to understand. All you need is a calendar, and it takes maybe 10 minutes a year to implement it. So it's something you should think about for a portion of your portfolio when you want to enter October 28th and then exit May 5th. It's a good, simple strategy. It's 100% mechanical. You know exactly when you're going to buy, hold, and sell. And you saw from the historical returns that the returns of the timing model greatly exceed the buy and hold approach with much less risk because you're in the market for a shorter period of time. So you're able to defy the conventional wisdom that higher returns require higher risk. And this strategy will outperform the vast majority of mutual funds and professional money managers and requires really basically no knowledge of the markets. You don't have to follow the markets, and you can ignore all the Wall Street hype. Very simple, basic approach. Is there any questions on the seasonal timing model? Okay, that ends Chapter 2, and now we're going to get into option basics. Okay, now we're in Chapter 3, and we're going to talk about option basics. And we're going to cover only the material that you need to know to implement option strategies. We don't have to get into complicated mathematical formulas. Okay, an option is also sometimes termed a derivative because its value is based on an underlying asset. And the value of the option is going to fluctuate with the price of the underlying asset. There's several things that can influence option prices: interest rates, dividends, stock splits. And when you buy a call option, that gives you the right to buy the underlying stock at a certain price before option expiration date. So a call option, it gives you the right to buy an underlying stock. And buying a put option, that gives you the right to sell a stock before the expiration date of the put option. The person who buys an option is referred to as the buyer, and they're charged or debited to their account with the price of the option. The person who sells the option is the seller or the writer, and the seller or writer will receive a credit in his account, cash credit, whenever he sells an option. So if he sells Cisco Systems 50 call option at $5, he'll receive $500 will go into his account if you're the option seller. If you're the option buyer, then your account will be debited for $500. And all option contracts are standardized, and they are cleared through the Options Clearing Corporation. At expiration, the purchaser, the owner of the option, no longer has a right to buy or sell the securities once the option expires. And the cost of the option is referred to as the premium. And the premium of any option consists of time value and intrinsic value. The time value will be based on certain factors like the time to expiration and the volatility of the market. The intrinsic value is the value of the option based on the underlying security, and I'll show you an example of that in a minute. Now, when you buy an option, you must be approved in your brokerage account, to buy options. Most accounts, including IRA accounts, will allow you to buy options. And if you buy an option, your risk is limited to the premium that you paid for the option. So you have to have enough cash in your account to pay for that premium. Now, if you sell an option, you have to have account approval from your broker to sell an option, and that usually requires a margin contract, unless you're writing a covered call. And a covered call trade doesn't require margin. You can do that in an IRA or retirement account. And when you sell an option, your risk is unlimited, and you must have margin in your account to cover that risk. Most of the strategies we'll be discussing today from the Guaranteed Real Income Program involve selling options, as opposed to buying options. Now, the underlying security can be a stock, it can be an index. There's also options on futures. It could be pork belly, silver. So there's a lot of underlying instruments that have options. And the option usually uses the same symbol that the stock trades at, if it's a stock. Okay, the strike price, that's the price at which the option holder or buyer will buy the stock. If you buy the General Electric December 110 call, you have the right, as the buyer of the option, to buy 100 shares of GE at 110 before the expiration. And the expiration date, the option contract becomes void. And the expiration is normally the third Friday of every month. And short options, if you're short an option going into expiration, if it's in the money, then you will be assigned automatically. And of course, as we said before, there's two types of options, call options and put options. If you buy a call option, you benefit if the price of the stock moves higher. If you buy a put option, you benefit if the price of the stock moves lower. When you buy a call option, purchase a call option, you're expecting the price of the stock to go up. It's a bullish strategy. And when you buy a call option, of course, the risk is limited to the premium that you pay. The profit potential, however, is unlimited, and as long as the stock keeps moving up in price, your profit's going to increase. And again, you can obtain leverage with a call option, because if you buy a stock, a $50 stock, and pay $2 for the call option, if that stock goes up 10 points, you're going to realize a big return on your money. So that gives you leverage without having to use margin. And for buying call options, you'd want to use your analysis on the stock. You use the fundamental analysis that we discussed, the technical and the seasonal. And once you found a good candidate for a call for a bullish position, then you'd want to buy a call option on it. And you can choose from in the money, at the money, or out of the money. And here's an example of buying a call option and the truncated risk or limited risk. This example is buying an Intel August 60 strike call. And the price for this is 2.5 points or $250. So if you buy the 60 strike and you pay 2.5 points, your break even is going to be around 62.5. So once you buy that option, once Intel moves above 62.5, then you start realizing profits. If Intel goes down, then the most you can lose is $250. And there's a price graph of your limited risk. Okay, and again, stock options versus stock ownership. Options have a limited life. When you purchase an option, the expected move has to occur before expiration. Whereas with stocks, you can just hold those indefinitely. So when you buy an option, you must be correct about the direction and the time of the underlying asset. When you purchase a put, that's a bearish position. It's also known as being long a put. And again, like a call option, when you purchase a put, the risk is limited to the premium that you paid, but the profit potential is unlimited. And of course, the put option benefits from a decrease in the price of the underlying security. Here's an example of purchasing a Amazon.com August 115 strike put option. And you can see if the this is the price of the stock at expiration along the bottom here. And as the price gets lower and the stock's dropping in price, your profit's going up. And again, your risk is limited. If the stock starts to go up in price and goes against your put, your risk is limited. And again, with put options, it's a wasting asset. You have to be right not only in direction but in time. However, it has the advantage of having limited risk as opposed to shorting a stock. Shorting a stock is one of the more risky things in the investment universe. But if you purchase a put option, if you're wrong, then you're limited to just the premium that you paid for the option. And the uptick rule doesn't apply, whereas it does if you're going to short a stock. It has to have an uptick before you can short it. Okay, that completes Chapter 5. All right, in this section we're going to talk about selling call and put options. This is one of my favorite strategies. Most of the educational material received from the option exchanges or brokers emphasize that being short options is very risky. And it is true that it is high risk, and when you purchase an option, your risk is limited to the premium that you paid. Whereas with selling options, you have unlimited risk. But if you're aware of the risks involved, it can be a very effective strategy for generating income. Okay, and one of the concepts that's not always emphasized is the fact that most options expire worthless. So if you purchase an option and it expires worthless, you lose all your money. But if you're a seller of an option and it expires worthless, that's good because you just you just incurred a profit. So a seller of an option, you want it to expire worthless. A buyer of an option, of course, you don't. Now, to sell options, you don't have to be a floor trader at one of the exchanges. If you can get approval from your broker to sell options, then you can be an option seller and sell options to open a position. And many of the strategies that we're going to take a look at here in the course involve selling options in some manner. Okay, now we're going to talk about selling puts. Selling puts against cash is a strategy. It's a bullish strategy, and you sell the put expecting that the stock will go up in value. If the stock goes up in value and the put expires worthless, then you collect the full premium, and that would turn into a profit. A trader who sells a put option just like a call option is known as the writer. And again, there's two types of put writing. There's the covered put writing and the naked put writing. A covered put writing, an investor would be short the underlying instrument and short the put. Okay, and put selling against cash, if you have cash in your account that would cover that put, let's say you sold the 50-strike put, you had $5,000 of cash in your account to cover that, that would be the same as if you were long the stock or the index. In other words, your risk would be equivalent to being either long or short the index if you don't use margin. And the risk in the put selling strategy, just like the call selling, is if the underlying stock declines by more than the premium that you receive for selling the put. And at that point, the premium no longer protects you, and you incur risk if the underlying stock continues to decline. And again, that risk is equivalent to owning the stock. And if you're going to write puts against stock, I recommend use a good quality blue chip stock to write a put, as opposed to a volatile high flyer stock. And the stock selection for put writing would be about the same as it would for covered calls. You want a blue chip A+ rated stock, or a dividend achiever, or a stock that consistently grows its book value or its real growth indicator. And again, once you do your fundamental analysis and you find a stock that you're going to write a put against, and you want to implement that bullish strategy, you would also do your technical analysis and make sure that the stock is in an uptrend. And this is very important if it's going to be a short-term call or a short-term trade, let's say 3 months or less. You want to use that technical analysis to filter out stocks that are not in uptrends. If you're going to write a leap put option that's 2 years out, then the timing of when you enter that trade is a little less important. You also gain a lot more downside protection if you sell a leap option as opposed to a 3-month short-term option. Okay, and the grip blue chip stock strategy, we're selling puts against blue chip stocks, and they're stocks that we'd want to own anyway in case we were assigned at option expiration. You'd wind up owning the stock if you don't close out the position prior to expiration. And there's 3 ways you can benefit. You can collect premium income from selling the put. Most of the time it would expire worthless and you'd collect the premium. You can also acquire blue chip stocks at below market rates, and you can also collect interest on your account. Okay, in this section we're going to cover one of my favorite strategies, covered call writing. Okay, in a covered call strategy, the investor purchases 100 shares of stock and sells 1 related call option. Unlike a naked short call, the covered call, of course, you own the underlying stock, and therefore your call is covered. Okay, and the two main objectives in the covered call writing is to receive premium income from the option that you sold, and this can reduce your downside risk and provide a cushion against an adverse move in the stock. And the risk associated with this strategy is that you begin to lose money once the price of the stock declines more than the value of the call premium that you received. And similar to the put selling strategy, with covered calls, you'd want to sell calls on stocks that you'd want to own anyway. Blue chip type stocks, A+ rated stocks, dividend achievers. And if you stick to these high quality stocks, then there's less of a chance of a earnings surprise or warning, which could drive the price of the stock down quickly and cause a losing trade. And again, if it's a shorter term covered call, then you want to check and make sure that the stock is in an uptrend. And if you already own the stock, of course, you could write calls during the unfavorable seasonal period, and that'll help increase your returns. And covered calls, normally it's a bullish to neutral strategy. In other words, you're expecting a neutral to a bullish move in the stock. However, they can also be profitable in down markets too, depending on how deep in the money you sell the call. And lately, over the last 6 months, I've been selling calls during the bear market in these blue chip stocks, and it's been working out pretty well because they've stayed stable or they've gone up a little bit, and I've been able to profit during the current bear market. Here's just a sample of some of the covered call trades I took. This was between 1997 and 1999. This is just a representative sample of the returns that I collected during that time. The average trade was 27 days. We had an 11% return, and the downside protection was 10%. And out of this group of trades between 1997 and 1999, I was about 90% accurate on the covered calls. I wrote covered calls on blue chip stocks, and I had a high percentage of accuracy. Now, I had a 27-day average holding period back then. Now I'm writing covered calls a little longer term, usually one to 1.5 years or 2 years in duration. Because of the volatility of the market, I want more downside protection now than I did back then during the raging bull market. And here's just a sample of what I call aggressive covered calls. These are mostly buying the stock and selling an out-of-the-money covered call. And with that, you get a higher percent return, but you get lower downside protection. Now is not a time that you'd want to be doing aggressive covered calls because of the volatility in the market. And here's just a sampling of defensive covered calls where these are actual trades that I made, and they were all profitable even though the stock went down in price during the period that I held the trade. These have more downside protection than an aggressive covered call, but they have a little less return. Okay, let's talk a little bit about actual trading results for the covered call program. I have some records here of an IRA account of mine and a KEO plan where I traded the covered call strategy. And just to give you an idea of the returns, I computed my actual return. And these covered call trades were recommended by my advisory service on my website. And keep in mind, these returns were achieved during a bear market in the NASDAQ and a lot of volatility in the financial markets in general. And here are the actual trading results. This is from October of 1999 through September of 2000. Account 789 is an IRA account. It started with $49,700 in October of 99. I added $79,000 to the account. The ending balance was $244,000, so I had a profit of $115,000, and that turned out to be a 193% return. This is my Keogh plan. The same time frame, October '99 through September 2000, started with $129,000, ended with $191,000. I had a $65,000 return, which equates to 52%. Okay, and now we're going to talk about exiting covered call trades that go bad. If you trade enough covered calls, you're going to pick stocks that go down. It's inevitable. And one of the advantages of the covered call strategy is if you buy a stock, sell the call, and the stock immediately goes down, you can get out, and you'll lose money. You lose a little money on the stock, but you'll make money on the call, and your net overall loss, is generally very small. Okay, and if you, let's say you wrote a covered call, and the stock takes a sharp drop below its 50-day moving average, or it drops below the 50-day moving average and stays below it. Obviously, it's in a downtrend, and you want to exit the trade. Your decision to exit the trade will also depend on your original price for the stock. If you have a large profit in the trade, then you have a little more leeway. If you buy the stock and sell the call the same day, simultaneous buy right is what they call that, then you have less leeway, and you got to get out when the stock goes into a downtrend. And in a simultaneous buy right situation where you buy the stock and sell the call simultaneously, in my experience, you can expect to lose 1 to 3 points on the trade if the stock drops 10 or 15% and goes into a downtrend. I averaged up 10 trades where I did a simultaneous buy right, and the average loss was 1.2 points, or $120. So that is pretty painless compared to just buying a stock and just holding a stock through a downtrend. So if you buy a stock, sell a call, and get out after it drops 10 or 15%, let's say you were wrong, my average loss was only $127. And this is an average. You can lose more or less depending on how much time is remaining until option expiration. Okay, here's some actual examples of covered call trades. And a lot of these are tech stocks that I owned last summer and started to exit when the tech stocks went into a downtrend. And here's an example. This is Sanmina. I exited the trade September 29th. That's about right here. You can see the 50-day moving average. It started to close below it. I exited the trade, but I still had a $5,900 profit on this trade because I did get out when it went into a downtrend. And of course, if I had held, it eventually kept going down, and I would have lost money on the trade. Here's another example, Power One. Exit around the same time frame when the tech stocks started to take a dive. September 21st, I exited with a $5,700 profit. Again, it continued its downtrend. Once it broke below its 50-day moving average, it continued its downtrend. Here's another example, Plexus Corp, exited in October, $7,100 profit. Again, these are all covered call trades. And here's an example of a simultaneous buy right where I bought the stock, sold the call, and then the stock started drifting down, went below its 50-day moving average, and I was able to sell the stock and buy the call back, exit the trade when it went into a downtrend. These are actual trades. And what I have listed here in the first column is the loss that I had on the stock. In this case, Lucent, I lost $3 on the stock, but I gained on the option, because the option, you make a profit on the option if the stock goes down. So the gain on the option was $2, and my net loss was $1. So out of these 10 examples, the loss on the stock was about $4, but I gained $2.87 on the option on average for an average loss of 1.27 or $127. So it just shows you that this is a much better strategy than just buying a stock and hoping it goes up. If you follow a disciplined approach and you do a simultaneous buy right and exit if it drops below its 50-day moving average, you can really keep your losses to a minimum. And these are very small losses compared to the profits I've made, which you'll see in a few minutes on the covered call strategy. Okay, and another thing I like to do is sell covered calls on stock that's already gone up in price. When you write calls on appreciated stock that you already have a profit in, obviously your returns are going to be higher and your downside protection will be greater. One of the nice things about selling a covered call when you own stock is it forces you to sell the stock at option expiration. If the stock gets called, it's automatically sold. And that's a hard thing to do when you have profits in a stock, is knowing when to sell it. So this can kind of help you if you have a profit and the stock gets called, you're out with a profit and it forces you to sell. Because a lot of people have a tendency, if they have a profit in a stock, they don't want to sell and they keep holding on, and the stock goes down and their profits evaporate. So this forces you to sell at a good price, because if the stock's moving up and it gets called, then you're going to automatically sell it. Another technique I like to use is dollar cost averaging, and in this strategy you would purchase the stocks in increments, but only if the price has moved up since your last purchase. If the price has moved down, then you're wrong and you don't want to make another purchase. And that way you can dollar cost average into it, and if the stock starts dropping, you're not going to buy anymore. If it keeps going up, then you're going to buy more as it goes up. And that's the best indicator to tell you that you're right, is if the stock's going up from your last purchase price. And I've been doing that lately with blue chip stocks like United Healthcare and Philip Morris, Cisco Corp. I've been dollar cost averaging in as these stocks have been going up, and then selling calls as they go up. So my cost basis is pretty low. I got huge downside protection, and a high percentage of those trades will wind up being profitable. One thing you want to do is never average down. If the stock's going down from your last purchase price, then you don't want to buy it. Okay, and here's an overall record this is from January of 2000 to February of 2001. These were covered call recommendations that I made on my advisory website. I used fundamental analysis, technical analysis, and dollar cost averaging in some cases. Other cases I did a simultaneous buy right, but this is the actual track record from the trades that were recommended on the website. There was 84 total recommendations, 83 winning trades, one losing trade of $475. That was on Texas Instruments. The total open and closed trade profit was $296,000. I have a list of those trades in the manual there. Here's a summary of those 84 trades. And total open and closed trade profit was $296,000. The average trade we're in 115 days. So I'm writing longer term options now than I did last year and the year before when we were in a big bull market. I'm writing longer term options. The trades last longer, but I get much more downside protection by using the leaps options. So the average trade lasted 115 days, and the average return was 22% on the trades. So that's a pretty good return for a 115-day holding period. And the average downside protection was 15%. So keep in mind that these trades were done during a lot of volatility in the markets and while the NASDAQ was in a bear market. And you'll see on some of these trades, they were tech stocks, but again, I started getting out of these tech stocks when they dropped below their 50-day moving average. And like Power One, I was only in that trade 15 days, but still made a profit. Sanmina, I was in the trade 29 days, still made a profit. SDL, was in the trade 12 days and still made a profit. But as those tech stocks started to drop, I just followed my discipline and started to get out. And I was able to get out with profits on most of them. And then at the same time, I noticed the blue chip, old economy type stocks were starting to go into an uptrend. So I started to switch gradually based on this technical analysis from the tech stocks right into the blue chip stocks. And you know, that's why I was able to maintain such a high average of winning trades. Okay, and just to summarize the covered call strategy, we get attractive returns while at the same time we get downside protection. Stock selection is very important with the covered call writing. It's somewhat less important if you use leap covered calls. And you should divide your trading capital into at least six different stocks or 6 different industries just for diversification. And again, trying to determine if an option premium is undervalued or overvalued based on the Black-Scholes model really doesn't have much to do with making money in options. The only way you can make money is if the underlying security goes in your direction that you expect. That's how you make money in options. Again, in the actual covered call trading results, since 1997, they've been over 90% accurate. And the losing trades, the losses on the losing trades have also been very small compared to the gains on the winning trades. The risk-adjusted return was virtually impossible to beat, and we were also profitable during the bear market. Most retirement accounts you can trade covered calls. Now Brian mentioned to me that he bought a stock and wrote some covered calls. The stock went down, but he thought he had to stay in the trade until the option expired. But I let him know that at any time, if the stock goes down and drops below its 50-day moving average, you can always sell the stock right away and buy the call back and close out the trade. And again, most retirement accounts will allow you to do covered calls. The Leaps covered calls provide substantial downside protection as well as returns. And selling covered calls also forces you to sell stock So it forces you to maintain a discipline because you're going to be selling the stock when it gets called. The leaps covered calls, we saw an example there. Even if the stock drops 50%, you can still make a profit on the trade. Of course, you're probably going to be out long before that as it drops below its 50-day moving average. Okay, we're done with Chapter 7. We're going to move on to Chapter 8. In this section, we're going to talk about option spreads, what I like to call limited risk vacation trading. And an option spread involves the purchase of an option and a simultaneous sale of another option, usually on the same security and the same expiration day. And the premium you receive from selling one option helps offset the cost of the option that you purchased. And your short option is covered by the other option that's purchased. There's 4 types of limited risk spreads. There's a bullish debit spread, which you use calls, a bullish credit spread that uses puts, a bearish debit spread, and a bearish credit spread. Now, when you're implementing a spread strategy, if the total price of the spread results in cash inflow to your account, then that's considered a credit spread. If there's a cash outflow out of your account, that would be a debit spread. Now, with these spreads, you only need a small amount of cash in your account to trade these spreads. Your losses are limited to a predetermined amount. They're ideal for small accounts and for beginning traders. With a $3,000 account, you could trade 5, 6, up to 10 spreads in a $3,000 account. At the same time, you'd have limited risk on all those spreads. These spreads are particularly useful in today's volatile markets because, again, once you initiate the spread, you know in advance how much your possible loss is going to be. So if you have a stock that you like and you don't want to risk a lot of money, then this would be your answer. You could write a spread on a stock and your loss would be limited. In most cases to about $200 or $300, depending on the spread. You don't have to monitor these spreads. Once you put the spread on, you just let it go until option expiration. You can go on vacation, you don't have to worry about it. No matter how far the market goes up or down, your risk is limited. Okay, on a bull debit spread, you want to buy, this is a bullish strategy. You want to buy a call at a lower strike price and sell a call at a higher strike price. The calls normally have the same expiration date. You want to utilize this strategy if you have a neutral to a bullish outlook. And if you use in-the-money calls, the spread can be profitable even if the stock drops in price. And options with 1 to 3 months until expiration have the most leverage, but you have less time for the stock to move in the direction that you're expecting. And again, the investment is far less for an option spread than it would be to just purchase the stock. Now, these spreads have not only limited risk, but they also have a limited profit potential too. In this section, we're going to talk about market-neutral option spreads. Market-neutral option spread is a non-directional strategy that attempts to make a profit whether the market's going up or down. There's 2 types of market-neutral spreads. There's the debit spread, where you purchase a put and a call option, and on the same underlying security with the same expiration date. And with a credit spread, you sell a call and a put option. Okay, the market neutral debit spread, your account is charged for the call and put option that you purchased. And you would only want to implement a debit spread is if you're expecting a huge move either way in the market. You'd have to have a large move to pay for the cost of the two options that you just bought. So you're expecting a big move, and usually, on average, that move doesn't happen. So the debit spreads on balance have a very low percentage of profitability. Here's an example of an out-of-the-money credit spread. And in this case, we would sell the S&P July 1425 call at 5.5 points and sell an S&P 1260 put at 16 points. Okay, so if we sell that 1425 call and sell the 1260 put, we'll get a credit in our account of $2,150. And the upside break even would be 1447, and on this spread the downside break even would be 1238. So as long as the index, when you're short those two options, as long as it closes less than 1446 and higher than 1238, then you'll realize a profit. And again, this trade will lose money if the index closes above 1446 or below 1238. They represent about a 7.3% move to the upside or a 6.6% move to the downside. So based on historical data, on average, the S&P is not going to move that high or move that low, and you'll have a high probability of the trade being profitable. Now here's a sample table for this credit spread. And in the first column, we have a list of S&P index closing prices at option expiration. And this represents an 1175 close in the index would represent a 11% decline in the index. And your loss on this spread would be $6,000. On the other hand, if the index rallies 13% up to 1,500, you'd show a $5,000 loss. So with the credit spreads, you want to implement those when you're not expecting a big move, because a big move up or a big move down can cause big losses in a credit spread. But anywhere in between, for the most part, you're going to realize a profit. All the way down to 1446, or if it goes up to 1446, you'll break even, and that's a pretty big move. So the odds are the index is going to close somewhere in here, and you're going to realize a profit. And you can see from that previous table that this spread incurs big losses if there's a large move in the index. Now, again, if you don't use margin on this spread, then your risk would be equivalent to either being long the index or being short the index. And by not using margin, if the S&P is trading at 1325 times $100, you'd have to have $130,000 in your account not to be margined. Of course, your losses are magnified when you use margin, and there were some traders that were short index options during the 1987 stock market crash, and they were wiped out because overnight the premiums increased, and they were short two options, and they got wiped out very quickly. So for this reason, it's recommended that you trade these market-neutral credit spreads without using margin, and that means either having the cash in your account or securities that's equal to the value of the underlying option contract. And the values right now for option contracts, the current values on the OEX, which is the S&P 100 index, is about $65,000. For the NASDAQ 100 QQQ Trust, it's about $5,000. The S&P index, $127,000. The Dow Jones, $10,700. So if you were going to do a spread in the NASDAQ 100 and you didn't want to use margin, if you had $5,000 in cash or securities, you would not be margined, and if the credit spread turned into a loss, it would be equivalent to being either long or short the NASDAQ index, depending on which strike price you exceeded. Okay, and the minimum margin, if you're going to use margin, the minimum margin is 20%. And if you don't have the cash or securities in your account that are equal to the value of the option contract, then you will be using margin, and you'd have to watch your position. And if the index starts to rally above your upside break-even or below your downside break-even, then you'd be forced to close out your position if you're on margin. Okay, in this section we're going to cover the GRIP investment grade income strategy. This strategy is designed to provide an alternative to the stock market. Fixed income investments should be a part of every investor's portfolio, and I'm going to show you why in a few minutes. It's as hard as it is to believe, there's a U.S. government zero coupon bond that has outperformed the S&P index by more than a 6-to-1 margin from 1982 through year 2000. Now think about that. From 1982 to 2000, we had the greatest bull market in history in stocks. And the zero coupon bonds have actually outperformed the S&P over that same period by more than a 6-to-1 margin. It's hard to believe, but it's true. An investment of $10,000 in government zero coupon bonds in 1982 grew to $726,000 by year 2000 versus a $123,000 return for investing $10,000 in the S&P index. So almost 6 times as much return, compounded return. Here's the year-by-year return. Again, we're comparing investing $10,000 in 30-year government zeros versus investing $10,000 in the S&P 500 stock index. And from 1982 to year 2000, the investment in zeros grows to $726,000. Investment in the S&P grows to $123,000. Did anybody know that before I announced that? It's hard to believe. All right, let's talk about investment-grade income securities. T-bills have a 90 to a 1-year maturity. Treasury notes from 1 to 10-year maturity, and bonds have a 10 to 30-year maturity. The zero coupon securities have anywhere from 1 to a 30-year maturity. U.S. government agency securities are also considered investment-grade securities. And some of these agencies would include the Federal Farm Credit Bank, Federal Home Loan Bank, Student Loan Marketing, and Tennessee Valley Authority. Also, the other category of investment-grade securities would be preferred stocks that are rated BBB or higher by Standard & Poor's. When you combine fixed income investing with your stock portfolio, you have the added benefit of smoothing out your returns and reducing the risk in your portfolio. Recent studies done by Ibbotson shows that a portfolio of 60% S&P 500 stocks and 40% bonds was 40% less volatile than a portfolio that consisted only of S&P stocks. So if you add bonds, you can reduce your volatility quite a bit. And normally when economic growth slows and the stock market earnings, if company earnings start to drop and the stock market starts to drop, usually the bond market starts to go into a bull market as the Federal Reserve lowers interest rates. In year 2000, the stock markets declined. All the major stock indexes had a negative return, but the fixed income securities produced a real good return. And in virtually all the bear markets that occurred over the last 100 years, the intermediate term treasuries actually rose in price. And I have a sample here. I have a graph here of the NASDAQ index, the return on the NASDAQ index, 1 year return on the NASDAQ, compared to the American Century Target Maturity Fund, 2010 fund. Now, the American Century Target Maturity 2010 fund invests in zero coupon bonds that mature in 2010. So what I did is I compared the NASDAQ return. Here's the NASDAQ right here. You can see there was extreme volatility, gut-wrenching volatility, and a very steep decline. On the other hand, zero coupon bonds that are guaranteed by the government had a nice steady increase, and they had a 25% return over the same period that the NASDAQ lost 38%. So this fund would be a good diversification in your stock portfolio to smooth out all the volatility associated with stock returns. Now, you want to keep in mind that these zero coupon bonds have no risk if you hold them to maturity. They're fully guaranteed by the government, and you will get your interest and principal back at maturity. So that's a guaranteed return. Over the long term, does anybody have an idea what the long-term return on stocks has been, say over the last 100 years or so? Anybody want to take a guess? The average compounded return on stocks? It's been about 11%. Now, we're all used to 20, 30, 40% returns during this great bull market we've had over the last 5 or actually it's I guess around 18 years now, since 1982. But the average return for stocks has been about 11%. 7% of that was from appreciation in the stock price, and that 7% is about equal to the growth rate, compounded growth rate of the GDP and corporate earnings. And the other 4% came from dividends. So over that long period of time, stocks have only averaged about 11% return. Okay, over the long run, stocks, of course, have outperformed bonds, but there's many periods where stocks became overvalued and bonds provided a superior return to stocks. Since 1960, there's been about 9 major stock market declines, or about one every 4.5 years. And these declines, as measured by the Dow Jones, have averaged about 28%. And historically, after stocks reach high valuation levels, they tend to produce very meager or even negative returns for several years. It may take several years for the NASDAQ to recover from its recent high. It may take more than several years. And to demonstrate this recovery period, I've got a graph of the Dow Jones from 1970 through 1982. And you can see here's 1970, here's 1982. That's about a 12-year period, and the Dow actually lost money. So if you were retiring in 1970 and you had all your money in stocks, hoping to get an 11% return, it didn't happen. That's a long time to go without a positive return. Common stocks right now are at their highest valuations in the history of the market. The market's up 98,000% since 1929. However, investment-grade securities represent good value right now. They're not overvalued, they're slightly undervalued. And one of the ways we can compare the yields on investment-grade securities to the stock market is to compare the current yield on a bond to the earnings yield on a stock. The earnings yield on a stock is calculated by dividing the company's earnings by its share price. It's just the opposite of a PE ratio. Okay, Cisco Systems earned 41 cents a share over the past 12 months. And at the current price of 38, the earnings yield is about 1%. You can compare that to the current yield right now on U.S. Treasuries, which is at about 5.5%, which have no risk. So you can see stocks have gotten way out of whack as far as the yield compared to fixed income securities. Even at its current price, Cisco is still way overpriced compared to the yield that you can get on an ultra-safe U.S. Treasury. Okay, again, the stock's historically overvalued. In year 2000, the S&P 500 stocks was the most overvalued or the most expensive they've ever been in history. The S&P was priced at 45 times earnings in year 2000. That's 3 times higher than the historical average for the S&P, which has been around 15. So, most expensive in history. At 45 times earnings, the S&P stocks have an earnings yield of 2.2%. Again, you can compare that to ultra-safe treasuries, which are yielding 5.5%. In order for the S&P to produce an earnings yield of, let's say, 6%, the index would have to decline to around 550. I'm not saying that it's going to decline to 550. I'm just saying that it's relatively overvalued compared to fixed income securities. Okay, and I've got several comparisons here of the performance of the NASDAQ versus the Target Maturity 2010 fund. Again, the Target Maturity 2010 fund invests in zero coupon bonds that mature in 2010, 9 years from now. And you can see this is the 6-month performance. Again, the 2010 had a 14% return over the last 6 months. Whereas the NASDAQ, of course, has had a big decline and a lot of volatility. And here's the one-year performance of the Target Maturity It had a 25% return over the previous year, and the NASDAQ has had a 38% drop. Actually, it's more of a drop recently. Now here's a 10-year performance, and I bet you didn't think that a zero could outperform the NASDAQ over the last 10 years, but it has. The 2010 fund has actually outperformed the NASDAQ over the last 10 years. And there's been a huge bull market in the NASDAQ. So an ultra-safe government security has actually outperformed the NASDAQ over the last 10 years. Okay, I just want to recap the GRIP investment grade income program. The program provides a viable investment alternative to the stock market. Investment grade income securities are not only safer than common stocks, but they also provide a competitive return, especially when stocks get overvalued as they are now. And the investment grade security should be an important part of every diversified portfolio. And just to recap, we saw the table where the Treasury zero coupon bonds outperformed the S&P index during the Great Bull Market from 1982 through year 2000. We saw how we can double our money with risk-free Treasury zeros that are guaranteed by the U.S. government. And keep in mind, in virtually every bear market in stocks over the past year, intermediate-term Treasuries rose in price. The yields on Treasuries right now exceed the earnings yield of the S&P 500 index by more than 250%. And we saw where the zero coupon target maturity 2010 fund outperformed the NASDAQ composite index over the last 6 months, 1 year, and 10-year periods. Okay, in this section, I want to talk about mutual thrift stock conversions. Does anybody know what a mutual thrift stock conversion is? Okay, I'll tell you. I've been investing in these stock conversions since 1993. There's currently about 790 banks, mutual thrift banks in the United States, that are owned by the depositors. And many have been operating profitably for 100 years or more. These banks are not publicly owned and they have no stockholders. The profits in these banks accumulate, and the profits are mutually owned by the depositors at the bank. And the depositors cannot access these profits that have been accumulated over the years unless the bank converts to stock ownership in an IPO. This process is called a capital stock conversion. And during the conversion, the bank goes public, stock is sold in the bank, and with what is called a subscription offering. And after the IPO, the stock trades on one of the major exchanges. Most of the thrift IPOs trade on the NASDAQ, and a smaller number trade on the Amex and New York Stock Exchange. And you'll see that the IPO price for these bank stocks is usually far lower than the eventual price that the stock will trade at on the open market. In the April '94 issue of Worth magazine, Peter Lynch called these mutual thrift conversions the investment opportunity of a lifetime. And in the U.S., there's three separate banking systems. You have the commercial banks such as Citigroup, Chase, J.P. Morgan, regional commercial banks like Wachovia and SunTrust, and then the smaller commercial banks like Silicon Valley Bank Shares and Bryn Mawr Trust. And the second type of bank are thrift institutions, also called savings and loans. And the third would be credit unions. And reports filed with the Office of Thrift Supervision shows that the mutual thrift banks in the U.S. have a combined net worth of over $15 billion, and nobody owns that. The depositors own it, so nobody owns that until the bank converts to stock ownership. And in the October '95 issue of Worth, Peter Lynch remarked that investing in your local savings and loan is the closest thing to printing money that ever came a stock picker's way. Now, he's been participating in these mutual thrift conversions for many years, so he's very familiar with the process. In the past 20 years, over 400 of these mutual thrift banks have completed capital stock conversions. And during these conversions, their net worth was liquidated and distributed to the investors who purchased stock in the bank. Now, depositors who have accounts at these mutual thrift banks have what they call subscription rights during a conversion. And they're allowed to purchase the bank stock at the IPO price. And that's normally $10. If the depositors at the bank don't buy all of the stock, then the stock will go to what they call a community offering, and the public can buy the stock at the IPO price. A large percentage of these 400 bank conversions over the last 20 years resulted in substantial price appreciation from the $10 IPO price. Here's a recent bank that I invested in. This is Cambridgeport Bank in Cambridge, Massachusetts. That converted last year. Cambridgeport was founded as a savings and loan in 1853, and it accumulated $78 million in profits. In other words, over that 140 years, all the profits that bank achieved were just accumulated, and that became the net worth of the bank. The total assets of the bank was $721 million, so the ratio of the equity to the assets of the bank was about 10%. And in March of 2000, the bank sold 7.4 million shares were offered in the IPO at $10 a share. And at $10 a share, that stock was priced at 48% of book value, had a PE ratio of 9.6. The bank went public. I happened to have an account there because I mailed in a deposit several years prior. The depositors at this bank got a notice in the mail, and they had first priority to buy the stock. The depositors did not buy all the stock, and the stock was even sold to the public at the IPO price. And Cambridgeport Bank trades on the NASDAQ under the symbol PORT, for Port Financial. And at 48% of book value and a 9.6 PE, the stock was a good value. By February of 2001, which is less than a year, 11 months later, the price of the stock more than doubled, despite all the turmoil in the financial markets and the stock market. The price of that stock doubled. Here's a price chart, Port Financial. This covers a period from April to September of 2000. It's trading at even a higher price now. Now, there's a very interesting phenomenon that occurs when these banks convert to stock ownership. In the case of Port, the accumulated net worth of Port was $78 million. Okay, that was distributed. They received $74 million in proceeds from the sale of the stock. In other words, everybody that purchased the stock at $10 a share, that produced $74 million in proceeds to the bank. So you can see that the combined total of the existing net worth before they converted, and then the proceeds from the sale of the stock, was $153 million. So the net worth of the bank literally almost doubled when they did their IPO. And this combined net worth now belongs to the new shareholders of Port Financial, and is called shareholder equity. Another name for it would be book value. And we can calculate the book value by dividing the number of shares outstanding, 7 million, into the total net worth of the company. So on the IPO date, the book value was $20.55, almost double. So essentially you're buying stock at $10 that has a book value of $20 on the day that they do their conversion. So purchasing stock at 50% of book value or 50% of its breakup value helps limit your downside risk. And after the conversion, the new equity to assets ratio of Port Financial was about 21%. This 21% is a healthy cushion for just about any conceivable problems that the bank would encounter. The non-performing assets of this bank was only 0.7%, not even 1%. So this healthy ratio made Port Financial an attractive takeover candidate also. A takeover at $30 a share would be about 150% of book value. And this would be conservative compared to the current trend where these banks are being bought out at about 300% of book value. Now I think, Bob, you bought stock in a bank IPO, and I think it was bought out, wasn't it? You bought it at $10. Bob bought stock in a bank, a mutual thrift conversion, at $10, and then a year later the bank was bought out at $20. Right. So you essentially doubled your money.
Correct.
Okay. Okay, and Peter Lynch described this thrift conversion phenomenon in the October '95 edition of Worth magazine, and I'll just read this. He said, so when thrifts began to go public, there were no previous owners to pay off, as what happens in most public offerings. Instead of a big chunk of the proceeds ending up in the pockets of the company's founders, all of the money was returned to the company's till. For the lucky buyers of the shares, the result was the same as buying a new car for cash, then discovering that the dealer has left the cash in the glove compartment as a car warming present. Let's say the local savings and loan had a book value of $20 million, the result of decades of earnings built up inside the company. Then it went public and sold $20 million worth of shares in the offering. That $20 million invested by the shareholders became their thrift warming present to themselves. In effect, they were buying the business for nothing. And because their $20 million was injected into the savings and loan, the book value doubled overnight from $20 million to $40 million. Theoretically, each share was now worth twice as much as the investors had paid for it. That concludes the mutual thrift conversions. I wanted to thank everybody for coming today. And do we have any questions about any of the strategies? Okay. All the material we covered today is in the manual. And if I left anything out, it's all included here. I recommend you go home and read the manual and slowly digest a lot of the strategies and pick one out that is suitable for your risk tolerance. And thanks again for coming.
This has been a presentation of Tradewinds Publishing Company. For more information about this presenter or about any of the dozens of other investment experts in the Tradewinds catalog, call the toll-free number on your screen.